Well, I promise to bring you value, so hopefully this video will give you just that. The thing that's been really popular back in the 80s and 90s that is going to be coming back on vogue is what's called an assumable mortgage. The Globe and Mail talks about this in this article about how it can be so enticing for a buyer as well as for a seller to meet in value. And so what an assumable mortgage basically is, it allows the seller to sell not only the property, but the mortgage that's attached to the title with it. Now the buyer does have to qualify for that mortgage, but let's look at the advantage of what that could happen. So if we look at a standard purchase of, say, $1 million property, where the mortgage would say be about $800,000 at a 5.5% interest rate, you'd be paying about $4,800 a month would be the monthly payment, of which a portion of the principal would go to principal, $1,200, and $3,600 to interest. Now, over the period of, say, 3 years, that would be $126,000 to interest, and that'd be $49,000 to principal. Now, if we take that and we break that into an assumable mortgage, let's the assumable mortgage comes in at a rate of, say, 2.4. They got it a few years ago. It's a great rate. They have 3 years left. Now you turn that around and you say, okay, well, the payment on that would be $2,215, of which $45,000 would go to principal and $34,000 would go to interest. Now, I get it. The amount is different. So let's just say you got the mortgage at, say, $500,000, and you get a second mortgage at, say, I don't know, 8%, we'll say. And at 8%, that would mean you'd have another payment of $2,284, of which $13,000 over the 3-year period would go to principal and $69,000 would go to interest. If we take that and we put that in a graph, we can see this. We can see that the first mortgage is $4,800, paying $49,000 worth of principal and $126,000 worth of interest. When we look at the second situation where we assume the first at 2.4% interest, the first mortgage payment would be $2,215, making us pay $45,000 in principal and $34,000 worth of interest. And then we get a second at 8%, then that would be $2,289, $13,000 in principal, $69,000 in interest, with a total of $103,000 in interest. That would give us a savings of $23,000 in interest saved. So I think that's a significant amount of interest. Now, we do note that the payments totals are going to be different. When we look here, we're actually paying $4,800 a month for this one. Where here, that's $378 a month difference in payment. So it's a little bit of a lower payment structure as well, which you can either increase your payment to give yourself advantage on the interest situation or take the benefit of the cash flow. So we can see there definitely is value in taking a look at what an assumable mortgage can do. Now, if we look at dollars for dollars, if you did have the full amount of, say, the $500,000 down, and you wanted to look at the difference of just $500,000 at today's rates, just using a random number of 5.5 and yester rates of using a random number of 2.4, you could also have a savings of $44,000 should you have the $500,000 as the put down for the property. So hopefully that helps and show the value of what an assumable mortgage can do and how that can be an edge in being able to show to your sellers what you can provide as extra value and to the buyers, and for the buyers to be able to use that as a negotiating tool to try to, get a little bit more savings for your month-to-month basis. Thanks so much. And, click on the bottom if you want to get some of these calculators. You can run some of the scenarios for yourself to play these things out. And do not hesitate to reach out to us should you have any mortgage questions. Thanks so much.